Welcome to the deep dive. Today, we're tackling a really fundamental question for anyone thinking about their financial journey. It's passive versus active investing.
Right. It's a big one.
We got some interesting material here, mainly from a fictional podcast, botTalks. They had this lively debate.
Yeah, between Samantha Lee, who's big on passive investing, wrote the couch potato portfolio apparently, and Jordan Banks, a fund manager, arguing for the active side.
Exactly. And our goal isn't just to repeat their points, but to really dig into what makes these strategies tick, look at the evidence, and, help you figure out what might fit your own goals without all the jargon.
It really boils down to a core choice, doesn't it? Are you more hands-off, trusting the broad market over time?
Or are you jumping in, trying to actively pick winners and, outperform that market?
Like setting your GPS versus actively steering the ship, trying to catch every gust of wind.
Yeah, that's a good way to put it. And the Bot Talks material lays this out well. Samantha, on the passive side, it's very much set it and maybe forget it.
Sort of the slow cooker approach.
Right, like plugging your destination into that GPS for long-term wealth. The main idea is investing in broad market index funds. Think the S&P 500.
Mm-hmm. Buying a tiny slice of everything.
Pretty much.
Yeah.
So you get that diversification automatically. Key things are long-term focus, minimal trading, low fees are huge, and just avoiding trying to guess market moves.
And historically, that broad approach, it's done pretty well over the long haul.
Yeah, it has.
And a big reason why it works is that you're capturing the overall economic growth. It's just so hard to consistently guess which specific company will be the next big thing. Owning the market smooths it out.
That diversification is powerful.
It is.
Okay, so on the other side, you've got Jordan arguing for active investing. His analogy is more like being in the driver's seat.
Maybe like gourmet cooking instead of the slow cooker. Higher potential, maybe higher risk of messing it up.
Exactly. The strategy is picking individual stocks or maybe actively managed funds based on research, trying to anticipate market shifts, spot trends.
Right, aiming for returns better than the market index.
The idea is making strategic choices, actively managing what you hold, trying to get higher returns, and maybe some protection if the market dips.
And the argument for that edge is, a skilled manager could find undervalued companies or avoid risks that an index fund just holds on to passively.
Flexibility is a key word there.
Yes.
The ability to adapt.
Okay, so now returns. This is where it gets really interesting, right?
I think this does.
Samantha brings up the SPVIA reports. Think of SPVIA as like the scorekeeper for professional investors versus the market.
An independent check.
And she points out that most active managers, well, they struggle to beat the market consistently, especially over the long term. The 2023 report she mentioned, over 85% of U.S. active funds underperformed their benchmarks over 10 years.
Wow, over 85%.
Yeah, it's a pretty striking number. Shows how tough consistently outperforming really is.
And it's not just a one-off thing. Market efficiency is a factor. Information travels so fast, especially in developed markets like the U.S. Makes it hard to get that edge.
Very hard to consistently exploit an information advantage.
But Jordan pushes back. He sees the stats, sure, but he emphasizes that the top managers, the really good ones, can outperform.
He focuses on that flexibility again, right? Adapting to downturns, targeting specific sectors they think will boom.
Exactly.
And maybe in some areas, like emerging markets or very specific niches where information isn't quite as widespread, maybe active does have a bit more of a statistical chance.
That's a fair point. Less efficient markets.
Potentially.
So it brings us back to that tortoise and hare idea. Passive is the steady tortoise, just plugging along with the market, getting that compounding.
Right.
Active is the faster hare, using fancy tools, trying to sprint ahead.
But the question is, does the hare win the whole race? And fees. Fees are a big hurdle for the hare.
Oh, definitely. Samantha calls fees the silent killer of returns.
It's a good description. They just quietly eat away at your growth.
And it's hard to argue. She points out index ETFs often have tiny fees, like 0.03% annually. That's just 3 cents per $100.
Practically nothing.
Over 30 years, those tiny differences, they add up massively. She actually compared the difference to, like, the cost of a Tesla.
Yeah, the compounding effect is huge. Imagine two people starting with $10, both getting 7% before fees for 30 years. One pays 0.03%, the other pays 1%. The difference in the end is enormous, tens of thousands.
Wow.
It's just math.
Jordan, of course, argues that the higher active fees, maybe 1% or more, can be worth it if the manager delivers those better returns.
That's the big if.
His analogy was pretty good.
Yeah.
Passive is like a free yoga app.
Yeah.
Active is like a pricey CrossFit class.
Huh. Okay. Both can work, different costs, different engagement
So they
levels.
makes you think, are you willing to pay more for the chance of beating the market knowing the odds are tough?
Or do you prefer the near certainty of lower costs and market matching returns? It's a personal calculation.
Okay, let's shift gears a bit. Risk and emotions. Jordan argues active managers can potentially reduce risk by adjusting portfolios in downturns.
Moving to cash, maybe, or safer assets. That's the pitch anyway. The idea of downside protection.
It's appealing.
It is. But, timing the market is notoriously difficult, even for the pros. Get it wrong, and you can miss the recovery.
True. And Samantha really hammers the point about emotions being terrible for returns. Panic selling during dips, the classic mistake.
Buy high, sell low. We all know someone who's done it or been tempted to.
Passive investing, with its long-term focus, kind of forces discipline. It reduces the temptation to react emotionally or try to time things perfectly.
Yeah, it removes some of those triggers. Our instincts, that fight or flight thing, aren't always helpful when the market drops. Passive encourages a more rational approach.
Though Jordan adds a nuance there. He says active investing isn't necessarily emotional investing. It's about being prepared, having a strategy.
Fair point. Discipline is key for both, really. Passive investors need discipline to stay put. Active investors need discipline to stick to their research and not chase fads or panic.
Right. Okay, what about modern trends? Things like ESG, clean energy, crypto, AI. How did these strategies cope?
Good question. Things change fast.
Samantha points out that passive isn't just the S&P 500 anymore. You can get index funds and ETFs targeting these specific trends.
Yeah, that's a big evolution. You can be passive, but still align with specific sectors or values now. Diversified, low-cost exposure to themes.
But Jordan argues active managers have an edge here. They can spot and jump into these trends earlier, maybe before they're big enough for an index.
We can be more agile. Get in, maybe get out faster if things change.
His analogy was sharp. Passive investing in new trends is like reading about the party after it ends.
Ouch. But there's some truth to that potential early mover advantage for active, identifying the next big thing before it's obvious.
Huge potential reward, but also higher risk, right? Many trends fizzle.
Absolutely higher risk.
Samantha had a great comeback, though. She said passive investors still benefit long-term, even if they're late. Like, show up late, eat the leftovers, and still somehow gain 7% annually.
Huh. That captures the passive philosophy well. Maybe miss the initial surge, but capture the long-term growth more reliably, perhaps.
It highlights that trade-off again.
Potential versus probability, maybe.
Okay, this is fascinating. Warren Buffett, arguably the greatest active investor ever.
A legend.
Yet, he famously recommends passive investing for most people, specifically low-cost S&P 500 index funds.
Right. And he put his money where his mouth was with that million-dollar bet against hedge funds.
He won it, didn't he? Showed the simple index fund beat the sophisticated active strategies over 10 years.
He did. Coming from him, that recommendation carries enormous weight. It just highlights how hard it is to beat the market consistently, especially after costs.
But then you have counterexamples,
Right.
like Kathy Wood in ARK Invest, her early bet on Tesla, for instance.
Huge success, generated massive returns for her active funds for a while.
So it shows it can be done. There are definitely successful active managers and strategies out there.
For sure. It proves exceptional results are possible with active management. The challenge for the average person is finding those managers before they're successful and sticking with them. And again, the statistics show it's difficult.
Okay, final round. The elevator pitch for a beginner. Samantha's take.
Her message, based on the source, was essentially invest early, invest often, and stay the course. Build wealth with peace of mind. Don't obsess. Just let time work for you. Chill and grow.
Simple, clear, and Jordan's pitch.
His angle was more. If you're curious, willing to learn, and want more than average, active is your playground. Potential to outperform through research and smart moves.
So very different philosophies. One hands-off, low-cost market returns. The other hands-on, research-intensive, potential for more, but higher fees and more effort.
Like the botTalks host said, Zumba versus chess boxing.
Yeah, both can work, but totally different styles. Depends on you, your preferences, your risk tolerance, how much time you have.
And crucially, the strategy you'll actually stick with. Consistency is probably the most important factor in the long run.
Absolutely. So what's key for you, the listener, to think about?
Your own interest level, really. Are you fascinated by markets? Do you want to spend time researching? Or does that sound like a chore? Also, your comfort with ups and downs. Active strategies can sometimes be more volatile.
Good points. So wrapping up this deep dive, We've unpacked passive and active investing using that botTalks debate. We looked at the core ideas, the return evidence, the impact of fees.
Risk management, how they handle new trends.
Right. And the big takeaway really is there's no single best way for everyone.
Definitely not. It depends entirely on your goals, your personality, your risk tolerance, how much time and interest you have. Both approaches have valid points and success stories.
So here's that final thought for you to chew on. What really drives you with your finances? Is it simplicity, that steady, long-term growth with minimum fuss?
Or is it the challenge, the engagement, the potential thrill and potential reward of trying to actively navigate the markets for potentially higher returns?
Thinking about that might be the best guide to figuring out your own path. What kind of investor do you see yourself being?